Okay, about $3.12. That's roughly where Virgin Galactic stock SPCE is sitting right now, mid-May 2025. And you kind of have to wonder, right, is that price a bargain ticket to the future of space travel? Or is it more like a black hole for your investment?
That's exactly the question we're tackling today. We're doing a deep dive into Virgin Galactic SPCE using this really interesting value investing analysis one of you actually sent over. It's fresh off the press, dated May 17th, 2025.
Yeah, our mission here is to, cut through some of the hype, maybe the stardust, and really look at the fundamentals. We're talking the core business, who's in charge, the financials, which are, well, interesting where they fit in the market, and importantly, the risks and maybe the opportunities too.
Right. The goal is to help you get a clearer sense of whether SPCE has potential as a long-term value investment or if it's just too speculative at this point.
So we'll break it down. We'll look at what they do, the leadership, the money situation, market buzz, who owns the stock, and wrap up with a solid risk assessment.
Exactly. We've structured it to cover all those bases for you.
Okay, let's jump in. Chapter 1, Understanding the Business. What is Virgin Galactic actually doing? What's their model?
Well, at its heart, Virgin Galactic sells suborbital space flights. They target private individuals. They call them future astronauts. And the ticket price now is $600,000.
Wow, $600,000. That's up quite a bit from the earlier figures, wasn't it? Like 250K.
It is, yeah, a significant jump. But it's not just tourism. They're also aiming for research missions, using their platform for suborbital experiments. And interestingly, they're looking into potentially diversifying, using the mothership, VMSE, for things like airborne research, maybe ISR, command and control.
Okay, so it's potentially broader than just space tourism. What about the actual hardware, the spaceships?
Right, so their system is pretty distinctive. It's a two-part setup. You've got the big mothership VMS Eve that carries the spaceship up. The spaceship you probably remember is VSS Unity. It flew 12 times, took 65 people to space, which is quite an achievement.
Yeah, I remember seeing footage of that.
But Unity's now retired. They're focusing everything on the next generation, the Delta-class spaceships. They're hoping to start commercial service with those in 2026.
So Unity is parked. Everything rides on Delta now. What's the flight actually like for a passenger?
It's designed to be, well, unique. It starts like a normal plane, taking off from a runway with the spaceship attached under the mothership. Then around 44,500 feet, Eve releases the spaceship. The rocket motor fires, pushing it past Mach 3 up into space.
Wow.
Passengers get a few minutes of weightlessness, these incredible views of Earth, and then it glides back down for a runway landing.
That sounds amazing, but it's more than just the flight itself, right?
Oh, yeah. It includes a multi-day training program getting you ready.
Yeah.
And you become part of this future astronaut community. It's positioned as a very exclusive luxury package.
Okay, so where do they stand in the market right now? Are they actually flying passengers currently?
Well, they were pioneers, no doubt. They proved the concept with Unity and those 65 people. But right now, they're essentially in a pre-revenue phase for passenger flights.
Yeah.
All the focus, all the resources are on getting the Delta class built and tested. Delta is absolutely critical for them to scale up and eventually make money.
And the timeline for Delta?
Ambitious. They're targeting the first research flights for Delta in summer 2026, and then private astronaut flights starting fall 2026. So not that far off if they hit those targets.
So pulling that together, what's the core value proposition? What are they selling?
Their official mission is about connecting people to the love, wonder, and awe of space. So they're selling this transformative, once-in-a-lifetime experience, plus exclusivity. It's very much like a luxury brand. And, of course, the suborbital research platform potential.
But that sounds vulnerable, too.
Highly vulnerable. It depends heavily on wealthy people having disposable income, and their reputation is everything. Any safety issue is catastrophic. Plus, retiring Unity before Delta is flying creates this big revenue gap. That increases the execution risk on Delta massively.
And the diversification stuff with the mothership, could that be a distraction?
It could be. Well, it makes sense long-term. Right now, you could argue every ounce of focus needs to be on Delta. It's a balancing act.
Okay, so Chapter 1 recap. Suborbital flights, research potential, high ticket prices, exclusive experience, but currently no flight revenue, and huge reliance on Delta's success. Let's move to Chapter 2, management. Who's steering the ship?
The CEO is Michael Colglazier. He came over from Disney back in 2020. His background is strong in safety, scaling operations, manufacturing, customer experience, all important.
But maybe less direct aerospace development experience.
That's the nuance, yeah. His Disney experience is valuable for the experience side, but the immediate need is hardcore aerospace engineering and manufacturing execution for Delta. The CFO is Doug Ahrens. He does have experience scaling manufacturing from his time at places like Mellanox and Global Logic, which seems relevant.
So the key test for them is Delta.
Absolutely. Delivering Delta on time, on budget, that's the metric everyone's watching. That will really show their capability in this specific challenge.
They've faced challenges before. The 2014 crash comes to mind.
Yeah.
How has management handled crises?
Right. The VSS Enterprise crash in 2014 was tragic. Important to note, that was under previous leadership. The NTSB found issues related to premature feathering, design, training. The current crisis, you could say, is the strategic pause, the transition to Delta. Management's response has been to shift resources, cut costs, Q1 operating expenses were down, and communicate a clear timeline for Delta.
How clear is that communication? How transparent are they being?
They do the standard stuff, quarterly updates, earnings calls. They've also announced this new biweekly web series, We Build Spaceships, starting in June 2025.
Interesting. Like a progress report.
Seems like it. To showcase Delta's progress could be good for managing expectations. Their 2024 10K also had extensive risk disclosures.
But maybe not all the technical nitty-gritty.
Probably not. They need to protect proprietary info, especially in a competitive field. So transparency has its limits.
What about ethics? Reputation beyond the 2014 incident?
No major current scandals are apparent. The 2014 crash looms large in their safety narrative, understandably. ESG ratings are a bit mixed. Sustainalytics gives them a severe risk rating. ISS governance score is mid-range, but flags compensation as high risk.
Compensation risk.
Yeah, relating to executive pay practices. There's also a class action lawsuit ongoing related to disclosures back in 2021.
So that We Build Spaceship series, good PR, but needs substance.
Exactly. It needs to balance transparency with protecting their tech. And while Colglazier's Disney background is great for the eventual customer experience, right now the focus has to be nailing the engineering and manufacturing. That 2014 legacy likely drives an intense safety focus now.
Okay, bottom line on management. Are they honest, capable, shareholder-focused?
Honesty. Well, the communication on Delta seems fairly direct, but that past lawsuit lingers as a question for investors. Capability. Colglazier's skills seem geared for scaling after Delta is proven. The immediate need is maybe more technical leadership. Ahrens' background looks more relevant to the current manufacturing scale-up challenge.
And shareholder focus.
Focusing on Delta and cutting costs is arguably good for shareholders long-term. But the constant share dilution through ATM offerings isn't ideal. And that high compensation risk score is a red flag for governance-minded investors.
All right, let's dive into the numbers. Chapter 3, financial health. This is where it gets challenging, I imagine. Key metrics as of Q1 2025. Market cap.
Yeah, it's a bit tricky because of those ongoing share sales, but it's roughly in the $120 to $130 million range right now. Pretty small for a company with these ambitions.
TE ratio.
Non-existent, NA.
No.
They consistently lose money, so there are no earnings to calculate it with.
Revenue trends. You mentioned the flight pause.
Right. Q1 2025 revenue was just $500,000. That's down from $2 million in Q1 2024 because, well, they stopped flying Unity. For the full year 2024, revenue was $7 million, basically flat year over year. Future growth. It all depends on Delta launching successfully and scaling up.
Profit margins must be rough.
Deeply negative. Q1 operating loss was over $88 million. Net loss, nearly $85 million. For all of 2024, the net loss was $347 million. They're burning through a lot of cash.
What about debt? Debt to equity?
It's quite high, around 2.32. That's based on $631.8 million in liabilities versus $272.2 million in equity. A big chunk of that liability, over $420 million, is from convertible senior notes. So significant leverage.
And free cash flow, the burn rate.
Consistently negative and significantly so. Negative $122 million in Q1 2025. Negative $475 million for the full year 2024. And they're projecting another $105 to $115 million burn in Q2 2025.
Ouch. Okay. Press to book. Sometimes that tells a story for struggling companies.
It's low, around 0.47, but you have to be really careful interpreting that here. A low PZ doesn't automatically mean it's undervalued when the company is losing money hand over fist and relies on unproven tech like Delta. The book value might not reflect economic reality.
You mentioned those convertible notes again. What's the specific risk there?
Two big risks. First, if the stock price doesn't go up enough, they might have to repay the principal in cash when the notes mature. That would be a huge cash drain. Second, if the stock does go up, the notes can be converted into shares. That means more dilution for existing shareholders your slice of the pie gets smaller.
And all this while they have zero revenue from their main business.
Exactly. They're relying entirely on cash reserves and potentially more financing to get through this Delta development phase. It's a precarious position.
So overall financial stability, how does it look?
Look, the picture isn't rosy. Earnings. Consistent, significant losses since 2019. Dividends. None, and none likely anytime soon. Debt. High, with servicing ability dependent entirely on future, uncertain success. They have positive working capital, yes, but it's from financing, not operations. Those customer deposits around $82 million are like an interest-free loan, which helps, but it's also a liability. If Delta gets delayed or people lose faith, they might want that money back.
So there's a going concern risk.
Given the losses, the cash burn, the reliance on unproven tech, and the likely need for more funding, yes, that's definitely something investors need to consider seriously. It's implicitly there.
Okay, quick financial recap. Not profitable, weak balance sheet, burning cash rapidly, high debt, totally reliant on Delta succeeding.
Got it.
Now that takes us into the second half, Chapter 4. Market sentiment. What's the vibe on Wall Street?
It's all over the place. Analyst price targets are incredibly wide. We're talking from about $1 up to nearly $38. The average is around $9, but that average hides the extreme disagreement.
Any recent analyst actions?
Yeah, Jefferies recently cut their target to $8, but they kept a buy rating contingent on Delta progress and hitting positive cash flow. So even the bulls have caveats. Investing Pro, on the other hand, suggests it might be overvalued right now. You've got neutrals from Susquehanna and Goldman Sachs, and Morgan Stanley is underweight. So, yeah, no consensus at all.
How's the stock reacting to news?
Interestingly, it got a bump after the Q1 earnings. Even though the cash flow was still negative, the market seemed to like the cost cuts and the reassurance on the Delta timeline and progress.
So signs of execution discipline are being rewarded.
Seems that way. There was also minor news about a stock award to a new hire.
What about short sellers and options traders? What are they signaling?
Short interest is very high, around 27–30% of the float. That's a lot of people betting against the stock. It would take about 5 days of normal trading for them to cover their positions.
That's significant bearishness.
Definitely. And the options market is buzzing too. Lots of activity in both calls and puts, stretching out to expirations in 2027, which lines up with the Delta rollout timeframe. You see significant open interest, for example, in the January 2027 $5 calls and the $2 puts. It really screams battleground stock. Meaning very polarized opinions, bulls betting on the massive potential if Delta works, bears focused on the huge execution and financial risks. The market seems laser-focused now on financial discipline and tangible Delta milestones. Those far-dated options suggest people see Delta as a binary outcome, huge win or big loss.
Okay, makes sense. Chapter 5. Ownership structure. Who actually owns SPCE?
Institutions hold about 31–33%. Big names like BlackRock, Federated Hermes, Vanguard have stakes, usually a few percent each. Looking at recent trades, Federated Hermes and Morgan Stanley added to their positions, while Goldman Sachs trimmed theirs.
But you mentioned dilution earlier.
Oh yeah, massive dilution. Shares outstanding are up almost 100% year over year because of those stock offerings. That's a key factor for any potential investor.
What about insiders? Management, directors. Are they buying?
Insider holdings by officers and directors seem pretty low, maybe 0.2% to 4.7%. There's this large stake listed under Virgin Investments Ltd., which is likely tied to the founder, Richard Branson, but the specifics need clarification. As for recent transactions, there's been significantly more insider selling than buying over the last year. Names like Colglazier, Arons have sold shares.
Is that necessarily a bad sign? Could be tax-related?
It could be, yes. Often sales are linked to vesting stock units or options, but the lack of significant open market buys by insiders might be seen as telling by some. They did grant some inducement stock to a new hire, though.
How concentrated is the ownership? And what about governance?
It's moderately concentrated among the top institutions. But that big Virgin investment stake adds uncertainty about control. Public float seems to be around 65%. Governance-wise, we mentioned the ISS score being mid-range but flagging compensation as high risk. And the Sustainalytics ESG rating is severe risk. Plus, that 2021 class action lawsuit is still out there. These are definite yellow flags for governance.
Okay, let's bring it all together in Chapter 6. Risk assessment, using a SWOT analysis based on everything we've covered. Strengths.
Okay, strengths. Strong brand recognition, that pioneering flight experience with Unity, unique assets like Spaceport America and their tech, those customer deposits providing cash, and experienced leadership, albeit with some caveats on specific expertise needed now.
Weaknesses. Seems like a longer list.
It is. No current flight revenue, high cash burn and losses, total reliance on unproven Delta tech, the shareholder dilution, high debt load, the shadow of the 2014 safety incident, and those governance concerns, particularly around compensation.
Opportunities. What's the potential upside?
Huge potential market for space tourism and research if they can tap it. Delta succeeding would be transformative. Diversifying services with the mothership could add revenue streams, international expansion, maybe leveraging that Italian spaceport partnership, and clearly, there's pent-up demand for this kind of experience.
And finally, threats. The big hurdles.
Intense competition heating up from Blue Origin, potentially others. Massive execution risk on Delta delays, cost overruns, financing risk will they run out of cash. Regulatory hurdles from the FAA, another safety incident would be devastating. Economic downturns hitting luxury spending, potential U.S. tariffs impacting costs, and just general market sentiment turning against risky stocks.
You mentioned tariffs, the potential 2025 U.S. tariffs. How specifically could those hit Virgin Galactic?
Right. There's talk of potential new tariffs on goods from China, Mexico, Canada, possibly steel, aluminum, even a broad 10% import tariff. Big aerospace players are already bracing for impact. For SPCE, this could mean higher costs for parts and materials for Delta. It could cause supply chain delays, messing up their already tight timeline and budget.
Yeah.
That puts more pressure on profitability, obviously. Indirectly, if tariffs hurt the wider economy, that could dampen demand for luxury travel. As a smaller company, they might have less power to negotiate or find alternative suppliers quickly. It just adds another layer of financial strain and risk. Might push them towards more U.S. sourcing or that Italian option.
Okay, Chapter 7. Conclusion. Summing it all up, what's the verdict on SPCE as an investment today?
Well, look, based on everything in this analysis, Virgin Galactic right now is highly speculative. It doesn't fit the mold of a traditional value investment, not by a long shot. You've got immense potential, the allure of space, sure, but it's balanced against really substantial execution risk on Delta, financial instability, competition, regulation, safety. It's a high wire act.
And that brings us to our final thought, the end hook for you to ponder. Considering the absolute necessity of Delta succeeding and the very real financial challenges they face, is investing in Virgin Galactic mostly a bet on technology and the dream of space? Or does that powerful, enduring allure justify taking on these significant risks for you?
That's the core question. If you found this breakdown helpful, please do subscribe to the Stock Analytics AI YouTube channel. That's where the detailed analysis we've been discussing today came from.
Absolutely. And let us know in the comments if there are other companies you'd like us to give the deep dive treatment to.
Yeah.
We rely on your suggestions.
And just the standard but important reminder, this was for informational purposes only. It's not financial advice. Investing has risks, significant ones. Our discussion is based on info available as of May 17th, 2025.
Right. This analysis used AI tools, and you absolutely need to do your own homework. Talk to a qualified financial advisor before making any investment decisions. Be thorough.